Good morning, all. Thank you so much for joining us on Saturday morning. It is really nice to see you all here today, and I'm sure the topic has a significant role to play in ensuring we are all here on time to listen to our expert share her insights on the session. This is Grow with Satori's Leader in You, Lead in Circles series of educational sessions. This is our second session on wealth management. We had a session a couple of months ago by Neha. And wealth management has always been a very intriguing topic for most of us because for a long period of time, this has been something that the men held fort. And now that we all are gaining more insights and confidence, and now we really want to start managing our finances ourselves, it is imperative to learn about this in detail from experts. Who better than someone like Saumya Prakash, who has an extensive experience in this field to guide us through in this particular topic. I take pride in welcoming Saumya Prakash, our facilitator for today, to enlighten us with her ideas and her knowledge. Saumya Prakash is an accomplished banker with experience of more than 13 years in State Bank of India as a senior manager. She joined SBI as a direct recruit and was posted in 5 different states, led various teams, and worked under various domains like wealth management, credit, branch management, operations, compliance, and collections. She is a graduate of mathematics, an MBA in banking and finance, and holds various certifications in banking and finance. She is a personal finance enthusiast and loves to read and travel. I have been interacting with Saumya in the last 2 to 3 months to get this session going, and I can tell you for sure that she's a thorough professional. She wants everything in place, and I'm eagerly looking forward to listening what Saumya has to say today that is going to help us manage our finances better. Saumya, we're all thrilled and looking forward to the session. Thank you so much for being here today to enlighten us with your words of wisdom. People, please join me in welcoming Saumya with a big round of applause.
Thank you so much, Vaishnavi. Thank you, Shanti, and I'm thankful to Grow with Satori for giving me this opportunity to share my knowledge with all of you. Having worked in a bank in last 13 years, I've met a lot of customers of State Bank of India, and I know that it feels daunting to understand finance, but I will try to make it as easy to understand it. And whatever jargons I'll use, I'll make it very easy to understand for any common people. So let's start. I'm sharing my screen. Just a second. Is it visible, Vaishnavi? Yeah. So today's highlight would be why we should invest, financial goals, monthly, how to make monthly and financial budget, as the classes, tax planning, and the common mistake which we do while planning for our investments. So first of all, why invest? First of all, let's understand what is time value of money, and I'll make it easier for you by telling you about dosanomics. So dosanomics was a word which was coined by Raghuram Rajan, who was ex-RBI governor. And in one of his lecture, he was teaching the students what is inflation and what is time value of money. So dosanomics is basically that if today you are buying dosa at suppose 100 rupees, you won't be able to buy it at 100 rupees next year. It would be 105 or 110. So the value of your 100 rupees is going to decrease next year. And this is called time value of money. And why it will decrease? Because inflation will increase. So inflation is महंगाई, what we say in Hindi, right? So time value of money, the value of money decreases over time. And because of inflation, your value of what you are earning, if you are earning 1 lakh, the value will decrease next year. So why it is important to understand, and why, I mean, it is important in investing. Suppose you are keeping your money in savings account, and you are earning 4% of interest, and the inflation increased by 4%. So your actual earning is 0%, right? And if suppose you are putting it in FD and you are earning around, say, 6% or 7%, and inflation increased by, suppose, 4%, and uh, you are giving some tax also, because TDS is also deducted on FDs. So consider it to be 1%. So your net growth of your savings would be 7% minus 4% of the inflation and 1% of the tax. So actual return is 2%. So this is why investing is so important, that you can beat the inflation. Otherwise, if you put all your money in savings account or FDs, you won't be able to beat the inflation. Your actual value won't increase. So inflation, real returns, tax planning is again a very important thing. We generally we don't plan our taxes, or we do it in March. Uh, Otherwise, as a financial professional, I would say that you should start it in April itself. And I'll tell you how. Uh, Next is financial goals and mitigate risk. And we'll take all these things as we maneuver through other slides. So, how to make a monthly budget? What we actually do is we think that if we have to save something, it should be earning minus expenditure, and whatever we are left with will be our savings or investment. But this is a very wrong approach if you are serious about your investing. The right approach is earning minus savings and investment, and what is left, that should go to the expenditure. Suppose you're earning 50,000 per month, and you decided that this year I'm going to save 60,000. So per month you have to save 5,000 for that. So before the month starts, when you are about to get the salary, if you have set SIs, which is standard instructions, or you have SIPs, then it will get deducted that 5,000 after the salary, and you will be left with 45,000, which you can spend on your expenditures. So that is how you can make a monthly budget, that how I will save it per month. Don't do it the way most of the people do, is that first I'll see what my expenditure is, and then I'll save. First save and then do the expenditures. Second is yearly budget. So in this book, Rich Dad, Poor Dad, Robert Kiyosaki talks about mind your business. What is mind your business is every business, how do they assess how they have performed from last year? So they make a asset liability statement, or they make a balance sheet. We compare that what was their balance sheet last year and what is this year, and how much they have improved from last year. This is how a company is assessed on their financial performance. But what if we make this financial performance for ourselves also? It is not very tough. It is very easy, but we don't do it because we don't know it. So it is mind your business. Even if you're earning as a salaried person, you can always have a business. If you think your finances as a business, then you should compare your financial standings last year to this year, so that you can compare that how you have performed financially from last year, how much you were able to save or invest. For that, we need to make one asset liability statement. And in the next slide, I'll tell you how to make that asset liability statement and do the tax planning in the starting of the year itself. I mean, it should be started in April itself. Like, if you want, even if a person is planning taxes on time, he would be able to generate good amount or will be able to have good wealth by, I mean, in 5 years or 10 years, you can say, because government allows you to invest 1.5 lakhs in ATC, and there are other sections also where you can save taxes. So even if you are doing that, you'll be able to save at least 1.5 lakhs per year. So that is not bad. And with compounding, it increases over time, right? So this is how you should make a asset liability statement for yourself. You can make it on Excel or you can do it on paper as you wish, and you can make a asset side and liability. So asset side is basically what assets you have. Assets, I mean, if you have a home, suppose, sorry, I've not written it. It is, the figures are in lakhs. So you have a home which its value is around 50 lakhs. You have mutual fund and the value is 5 lakhs, gold 5 lakhs, FD 5 lakhs. And so total your this assets is 65 lakhs. Liability side, you'll write all the loans you have, home loan, other loan, and the total will come in the end. And after deducting total of liabilities and assets, you will get your net worth. What is your net worth? So this should increase every year. And you can do it on Excel sheet if you're comfortable in Excel sheet, or you can do it so that you can assess your financial performance from last year to this year, how much you were able to save, how much you were able to invest, and what are your goals. Are you going to reach to your goal? Suppose you have a goal that in 3 years, in 5 years, or in 10 years, I want 25 lakhs or 50 lakhs to be saved or invested. And this is not just saving, it is also that you'll be earning some interest over it. In some of the asset classes, you get compound interest. And we all have read about simple interest and compound interest, that in compound interest, we earn interest on interest also. So over years, it increases a lot. So if you're doing this, you'll be able to see that how you're performing. And it is not a very tough task. Anyone can do that. Uh, Next is, I'm talking about life insurance, because we generally consider life insurance as to be not so important. But whenever, as a financial professional, we used to talk about this, we always told the customers that when you buy a vehicle and the moment the vehicle leaves the showroom, before that you have to get that vehicle insured. But we don't care about our own lives on which our family are dependent, right? So insurance is very important, and it should be adequately covered. Like, suppose if I have a loan of 50 lakhs and I die tomorrow. I mean, it is not easy to talk about death. We don't generally consider talking about our death, but this is a reality that I might, if something happens to me tomorrow, I'll leave this debt to my family. So if one person is earning in a family and he's not adequately insured, suppose he has taken insurance, but his insurance is of 30 lakhs. So what the family will do? The family will, because they have loan also, they have to look up about, I mean, the kids also. And with 30 lakhs, you won't be able to uh, do everything. I mean, you have bank will ask for their debt, right? So in that case, you should be adequately covered. There are mainly three types of life insurance. One is term insurance. There are saving plans and ULIP plans. Term insurance is where you cover yourself for a particular term, say 40 years or 50 years. You pay the premium, and but you don't get anything in return if nothing happens to you. But this is for coverage of your family. In term insurance, the premium amount is less, and if you take it as early as possible, like at the age of 25, if your premium was 20,000, it will remain 20,000 till the whole term. I mean, till 40, 50 years. So the earlier you take, the better it is. Although you're not getting anything back if nothing happens to me, and no one would like that death should happen to anyone, but uh, covering through term insurance is we suggest that everyone should have a term insurance, because with low premium you get coverage of more amount. I mean, you can take a 1 crore insurance and maybe 20,000, 25,000 if your age is between 25 to 30, right? In saving plans of life insurance, they give you a particular interest amount, like this may run for say 15 years, 20 years, 25 years, but you'll get the money back with some interest on it. It is same like saving FD accounts, but in not you're not just getting the money back, you're also covered. And if anything happens during this time, then the family will get whatever insurance amount was. Suppose you have taken insurance of 10 lakhs for 15 years, and you have paid a premium of say 5 lakhs during all these years. You will get 5 lakhs plus some interest back to you if nothing happens to you within these 15 years. But if something happens to you, then the family will get 15 lakhs, right? ULIP is unit linked plan. It is linked to market, and some of the amount is invested in the market. A small portion of the money invested goes to securing your life, whereas the rest of the money is invested in the market. There is some error in the slide. So this is market linked, so there is always a possibility that maybe it will depend that how market performs, and so there is some risk linked to it, and not everyone is comfortable with ULIP plans. But if you want growth for a long term, you can go for ULIP plans, but term insurance is a must for everyone. Next is health insurance. Health insurance, one more thing, in from whatever premium we pay for life insurance, we get ATC benefit in tax also. In health insurance also, you get benefit of tax, but most of us don't take health insurance thinking that this is not important. But once anything happens in the family, then we realize that it is like uh, it can cost you a lot of your savings and investment if something bigger or critical illness ever happens. So health insurance is also good, and you can get tax benefits also. And for senior citizen, the amount is the premium amount can also be claimed as a tax saving. So there are mainly three types of health insurance. There are more. I'm covering just three. There are individual plans where you can take it for yourself. Family plans where you can cover your immediate family, husband, wife, and kids. And critical illness. There are policies where you can cover critical illness like cancer and other critical illness. Now we'll talk about different types of asset classes. One is fixed income, equity, real estate, gold, and cash equivalent. What factors you should consider while investing in all these asset classes? One is time horizon. Some of the investment need a lot of time for growth, risk tolerance. If you're investing in stock, and if you're investing in FDs are low risk instruments, and Stock market is little high risky, but over time it grows a lot because you get the benefit of compounding also. Risk versus reward, what risk you are taking and what reward you are earning. And last is tax saving. So these are 4 points that is very important to consider while selecting what asset you would be choosing. So in fixed income, the risk is very low, and options are fixed deposit, government schemes like PPF, senior citizen savings scheme. This is for senior citizens. Post office deposits, fixed income of mutual funds also are comparatively low risk instruments. Here I have mentioned few of the fixed income like national saving time deposit. Some of these can be purchased from banks, some can be purchased from post offices also. In national savings account, like it is for 5 years, and you can get tax benefit also, ATC deduction benefit. In PPF, this lock-in period is for 15 years, and it can be increased, renewed for next 5 years also. The benefit of PPF is that you get an ATC benefit, and whatever interest you earn after 15 years, whatever amount that you will get is also tax free. Suppose you have invested 15 lakhs and your total with interest, it comes out to be 20 lakhs. So there won't be, after 15 years, when you'll get the money back, you don't have to pay any tax on that 20 lakhs, right? Next is National Savings Certificate. This is again for 5 years. You get ATC benefit, Kisan Vikas Patra. It is not, although eligible for tax benefits, and it can be it can also taken from post offices. Sukanya Samriddhi Yojana, this is for girl child, and if you have a girl child, you can think of it investing in it. The lock-in period is of 21 years, and only 50% of this can be used for higher education of the child, and rest amount will go for her marriage. And the parent can claim ATC deduction on whatever they are investing in Sukanya Samriddhi Yojana. There are other many schemes. I've covered only a few of them here. We can do it in next session if you want. Equity. So equity is shares, stock market, and mutual funds, IPO. And equity is basically you are buying a part of the business. Like suppose Reliance stocks, if you are buying. So what Reliance is doing is that Reliance needs money to run their business. And instead of taking loan from the bank, they float their shares in the market, and they tell you that whatever we will earn will give you the part of our profit through these shares. Like if you are holding 100 shares of Reliance Industries, then whatever profit per share is given, it will be given according to the whole how much holding you have in shares you hold. So you get dividend as well as growth on those shares. I'll not be talking much about shares right now, although I'll cover this because if you see in 1985, if you can see that how Sensex has was almost at zero, and right now it is around 71,000, right? So if you invest for a very long time, you get a lot of benefit. Sometimes people get discouraged when their money dips because of one reason or the other. Suppose someone invested the money in February 2020, and in March 2020 we had lockdown and the market crashed. So those people will get discouraged that stock market is not good. But those who survived for next 2 years and didn't stop their SIPs or didn't uh, withdrew their investment, they earned a lot of profit during that time because the market had crashed, and after that it recovered and it is at 71,000. So it has almost doubled from that period. Now, the type of mutual funds, mainly there are three types of mutual funds. There are other, but I'm not covering it in this session. Large cap, mid cap, small cap. This is large cap, mid cap, small cap. This is based on what is the market capitalization of the company. The bigger companies have more market capitalization. So they are large cap, middle companies, and you can think of it as small companies. And these small companies can become mid cap or large cap in next 3 to 5 years. Large cap gives you around growth of this is the performance of mutual funds in last 1 year, 3 year, 5 years. So you can see that large cap gives you around 12% 1 year return, 22% in last 3 years. And this is data of June 2023. And in 5 years, it has given around 11.68%. Mid cap has given 13.56%, and small cap 15.71%. So you can allocate your resources, or you can choose the asset class or any mutual fund based on what is your time horizon. Because if you're taking large cap, it should be invested at least for 3 to 5 years, at least 3 years, to get a good amount of return. If you're choosing mid cap, it should be 3 to 5 years, and for small cap, 5 to 10 years is what is recommended. So, benefits of mutual fund can be that it can be invested lump sum or through SIPs. SIPs are systematic investment plan where you can start with 500 rupees. It can be invested through distributors. Distributors are banks, and they have either bank branches, or the mutual funds have their own offices established at some of the places. Directly, you can also invest it through directly through the demat, or from the you can buy it directly from the fund house from their own site. Like suppose if you want to buy SBI mutual fund, you can just go to their site and you can buy it from there. Or you can also buy it from mutual fund utility site, or camps. There are other options also, and from where you can invest, or you can contact any financial advisor who will tell you that how you can buy and which will suit your needs, your goals. Tax on it is that for 15 years, 15% for short-term gain. Short-term gain is if you withdraw the amount within 1 year of your investment, and 10% for long-term gains. Long-term is considered to be after 1 year. And if you withdraw more than 1 lakh, then only it will be applicable, this gains. Because after 1 year, if you are suppose you invested 2 lakhs and your gain was only 50,000, and if you would withdrew that 2,50,000, then you won't have to pay any taxes. But it will, if it grew by suppose 1 lakh, and you are withdrawing uh, your investment of 2 lakh, and you're withdrawing it at um, say 3,50,000, then you will have to pay tax only of on 50,000, not 1 lakh. I mean, your total growth was 1.5 lakhs. You invested 2 lakhs, 1.5 lakhs, it became 3.5 lakhs, and you're withdrawing the whole amount, but you will not be paying any tax on that 1 lakh. Up beyond 1 lakh, you'll be paying 10% of tax on whatever you are earning. And if you don't withdraw it, then you are not going to pay any tax. If it is suppose lying in your mutual fund, then you don't, just because you're gaining growth, only when you withdraw, you have to pay the taxes. And other types of mutual funds can be large and mid cap and small cap, flexi cap, multi cap, thematic funds. They are also balanced fund where equal amount of or some percentage is uh, invested in stock market and some in debt funds like government bonds, etc. where you get the flexibility of both. You get the growth as well as some safety, because the funds are also invested in debt market. Third asset class is real estate. We all know about it. Residential, you can buy residential property, commercial property, land. Fourth is gold. And gold is considered to be high risky because its annualized volatility is more than 18% as per SEBI. Options are that you can invest it as physical gold, sovereign gold bond, gold ETF. I'll be talking about sovereign gold bond and the benefits of it, because uh, if you want to invest in gold just for investment, then the benefits are that it is secure, no storage hassles like physical gold, can be held in demat form and is tradable on exchanges, no GST and making charges unlike in physical gold. Maturity period is for 8 years. And these sovereign gold bonds are floated by RBI. You can buy it from your, you can purchase it on your demat account or through any bank branch. And you get a short return of 2.5% per annum, which is payable half yearly. And there is no capital gain tax if you withdraw it after 8 years. The maturity period is 8 years. So this is a very good uh, instrument for investing in gold, because you are not going to pay any making charges, or you don't have to pay GST, and and in everyone's portfolio at least 5 to 10% should be in gold. Last is cash and cash equivalents. So cash and cash equivalents, as I told you, that although this class does not uh, beat the inflation, but still you should have some cash and cash equivalents, because it is easy to withdraw whenever you need it. Second is you should have an emergency fund. For emergency fund, you won't be able to withdraw the money from mutual fund, or maybe if the market crashed, your deposit, your investment is not up to the mark, the amount that you require. So you have to have some funds in cash and cash equivalents, and the options are savings account, recurring deposit, fixed deposit. There are flexible fixed deposits also, where a certain amount of deposit from your saving account go to FD, and you get the interest of FDs. And the benefit is it is flexible, because whenever you want to withdraw, you can withdraw it anytime. The FD will break and it will come to your saving account, and you can just use that amount. And when it is lying in the bank, it will give you rate of interest of FDs. There are some liquid mutual funds also, where you can put your money if you have to invest it for just 1 year or 2 years. If your time horizon is not very large, then you can go for liquid mutual funds. So for tax planning, as we all know that under ETC, we can save tax up to, we can save up to 1.5 lakhs to save tax. And there are other instruments as well, other than ETC, where we get the tax benefits. Under ETC, we can get benefit from life insurance premium, whatever we invest in PPF, ELSS. ELSS are equity linked mutual fund, where you have to be invested in for 3 years. Tax saving FDs, NSC, Sukanya Samriddhi Yojana, and the principal amount that you pay on your home loan if you have one. Other than ATC, health insurance premium, NPS, interest on home loan, medical treatment, these are over and above 1.5 lakhs. You can save tax over and above 1.5 lakhs by investing in these instruments. Health insurance, for whatever you pay as premium for health insurance, NPS, interest on home loan, medical treatment, or interest on education loan. So these are some of the common mistakes which I have seen, and so I wanted to discuss about this. That the mistakes which we usually make is that starting our journey late, uh, because as you start, I mean, if someone starts at the age of 11 years, like Warren Buffett did, and is a billionaire, multi-billionaire, so and most of his money grew after he turned 60. He was at around some billion, and even at the age of 90, he's earning good amount because of the compounding effect he had. He never left that journey. So the more you are in this field, the more you for a longer time you are invested in stock market or through mutual funds, you'll get that benefit of compounding for long term. Insurance coverage, I talked about this, that if insurance coverage is not adequate, that is one of the common mistakes people make. Not buying health insurance is another mistake which people make, because once anything goes bad in the family or there is any critical illness, that then it can, I mean, it can affect your all the investment and savings at one go. So taking health insurance is also very important. Having your fund without any nomination, I've seen in banks that there are a lot of uh, deposits lying in the bank without any nominations, and after few years these funds go to the RBI because they are unclaimed deposits that are lying in the bank, and that RBI does not allow to remain in the bank, and the family does not know that they have some deposits of their family members lying in bank. So getting nominated all your funds is very, very important, so that once you are not there, your family will be able to take those deposits from the bank. Periodic review of your investment. Sometimes we either forget or we don't know how to review our investment, and for this we need to have that asset liability statement for ourselves every year, so that we can assess that how our investment is performing. And if some of the funds are not performing, then it is good to leave that one and invest it somewhere else. And the last is planning tax at the end of the financial year. You don't get the benefit of the whole financial year if you do it. I mean, you lose 1 year if you are investing. I've seen people who put their money in ELSS or PPF in the starting of the year, and they get the benefit of the whole year. So it is good that if you start your tax planning from April itself. So this is it. Thank you so much. And if there is any query, I would love to address that.
I do have a query, Saumya. I know one of the common mistakes is starting your journey late, but where do we start now? Understanding that it is late.
You should start as it is said, the best time to invest was if 10 years back, then the next time is now. So
Next
don't delay it. So don't delay it. Start as early as possible. If you find it difficult that from where should I start, where we can discuss it, that it depends on your goals. Like whatever I have told, I have given you the recipe. But if I'll tell you, if I'm making a food for suppose four, and like if I cook any recipe and they tell you that put 1 spoon turmeric, 1 spoon chili, but it always depends on my taste, right? Swadanusar, what we say. So it depends on your Swadanusar how you put those assets in your portfolio. That what you're comfortable with. You're comfortable with mutual funds, you can go for that because there are some risk uh, attached to it. And if you're going for fixed income deposits or something, there is opportunity cost that you will lose. I mean, in opportunity cost is basically if you're suppose putting your money in FD, you're getting 7%. In mutual fund, you can get 12%. That difference of 5% is your opportunity cost. And that risk, if you are ready to take, then go for it. Go for the mutual funds.
Yeah.
I also have a question. Soumya,
Yes.
you did mention about fixed income mutual funds and liquid mutual funds. Can you tell us more about these funds?
One liquid mutual fund and one
Fixed income.
fixed income is like where you suppose someone retires and he got some amount lump sum and he doesn't know what to do with it. But they need, I'm talking about retired
Pension, something
person.
similar to pension.
Yeah.
You want something month
But
after month.
yeah, if you need some income regularly, but you can invest that amount you have got the lump sum, you can put that in fixed income funds. Some of the fixed income funds are like where you are investing something and you will get a certain amount back every month, or say whatever increase will be in that deposit or investment, you will get it monthly. If you put it in lump sum, you will get some amount monthly in your account.
My understanding was mutual funds are very volatile because it is based on market conditions because they
Right.
invest predominantly in equities and other things. So I'm wondering how can it be fixed in a
Yeah,
from a
right.
mutual fund instrument? That's my
Okay. See, mutual funds don't invest everything in the stock market because the fund managers also know that this is very volatile. And if someone will require this money back after, suppose after 3 months, you invested and after 3 months, you need the money back. So the fund manager also knows this. And as you know that mutual funds and stock market is regulated by SEBI. So according to SEBI, they have to put in some money in debt funds. Debt funds are government bonds where they get fixed income. Government also gives you bonds. Suppose government has to build one bridge somewhere. So where will they take the money? They give the bonds, either they buy it or they sell it to RBI or any bank, and they say that I'm giving you this instrument. Once my work is done, I'll give you so much interest in 10 years, right? So these are bonds, and these mutual funds also buy these bonds from government. So they have those funds where they get fixed income. So from that income, they give it to the customers.
okay.
And and in every fund they have some liquid funds also, so that whenever it is required, whenever anyone is redeems their mutual fund units, they get the money back from that.
So liquid funds are separate or how does it operate?
They are separate. I mean, within, suppose in SBI, if I talk about SBI mutual fund, SBI mutual fund is a company in itself, right?
Mhm.
It is SBI has other companies as well, like SBI Life Insurance, SBI Mutual Fund. In other banks also, like Kotak has their own life insurance company, their own mutual fund company. So in mutual fund company, they have like in FDs, we have suppose 10 kinds of FDs. We give a lot of flexibility. We are giving you different rate of interest. We are giving some rate of interest, some differential rate of interest to senior citizens. There may be some FDs where you get some more interest as a woman customer. Similarly, in mutual fund, there are different funds, and in different funds, different, it is called, there is a key information memorandum where it is written that that amount, whatever they are taking from the people, where they are going to invest. Suppose it is a large cap fund. So they will invest most of their funds in large cap. But most of the means, suppose 70 to 80%. Rest 20% will be invested in bonds, government bonds, or liquid funds, or they'll keep some funds in as cash also. Similarly, there are if in every mutual fund there are 100 kind, not 100 but 20 25 kinds of funds: large cap, mid cap, small cap. There are mixture of that, multi cap, flexi cap. So they have liquid funds also, where they know that in liquid funds mostly they invest in government instruments like government securities, and these government securities are suppose SBI needs 500 crores right now, and they don't have. So what will they do? They will either borrow it from bank, or they can purchase it from other bank. So they also issue such kind of small bond kind of, where they say that, okay, I'll take this 500 crore from Canara Bank, suppose, and I'll give you 5% on it for next 3 days. I will keep that money because I need it urgently, and I will give it back to you after 3 years with 5% of interest. So these instruments are also floating, which the mutual funds buy, and they hold these instruments in their different funds, where and these are invested for liquid funds. Because they are not for very long time, they are for 3 days, 5 days, 6 months, or I mean, their maturity period is usually less than 1 year. So from that, the mutual fund investments are made.
Okay. Thank you for that clarification.
May I add to her point?
Yes, please.
Sorry. Yeah, this is Banu. I'm a financial advisor too. I just wanted to learn more. That's why I was very keen in knowing what Saumya is going to. Good thoughts. Whatever you told, of course, a lot that we practice, we preach. We don't practice. We of course only tell to others. We don't do. Like two things. One question, because I'm a person who like to interact. So sorry for taking your piece of this hour is yours, Saumya, and I'm taking your piece.
It's
Please
perfectly
don't
fine.
mistake
I'm
me. But I
always
thought
learning.
we are all women. I thought we should share with each other. That's the whole
Right.
idea. Mistake me not at all, girls. It's a dear thing. So Shanti, you asked, how do I start and where do I start? Just look at what your purpose is. If you want to retire, you want to save for your retirement, then retirement is my core. Then look at options for retirement. You have tens of hundreds of instruments that you can invest for retirement. So what is my fixed expenditure that is going to be incurred once I retire? When I retire, I have some certain fixed expenditure at home, like maybe the groceries, of course, house, if at all there is a house rent, even that is a fixed expense. House rent, the basic expenditure. For that, invest in fixed instruments like insurance and annuity plans, because the expenditure is fixed. Invest in fixed instruments. And there are some variable, always there are variable expenditure in every household, even today, like going out of town, some function, festival coming in the family, some function coming in the family, some birthday party, some events, and all of those are variables. So for those variable expenditure, invest in variable instruments like the mutual funds, equities, gold, however your risk appetite fits in, invest there. This is what I tell people. Maybe I answered a little more than what Saumya really told, if that helps you girls. Okay.
It helps,
so
absolutely.
And Vaishnavi, you asked like what is regular, what is it? Guaranteed regular fixed income. So there's something called systematic withdrawal. This is what Saumya, that word didn't come out of Saumya's mouth. It's as simple as systematic withdrawal plan. You have a purpose, you invest in a mutual fund or wherever, like your salary that hits your account on the 30th of the month. You say, I have 50 lakhs, I'm investing into mutual funds, where mutual fund is where the systematic withdrawal is applicable. You can invest actually in annuities also. So where you invest this amount, and month on month, my expenditure is 50,000 rupees. I will withdraw. My account has to be loaded with 50,000 on the 30th of the month. The remaining amount lies there, and supposing this 50 lakhs has earned in a month 60,000 rupees of interest. I only draw 50,000. So this 50,000 along with the 10,000 is there in your account. 50 lakh and 10,000 grows. Then the next month you draw 50 more thousand. Then 50 lakh, 10,000 the previous month. Then the 10,000 the next month. And the interest for the 20,000 again. So that keeps compounding. So you don't have a, like, how do we say, like this Akshaya Patram. There is no dearth. You keep on withdrawing, some is left there, and it keeps adding interest and compounding. compounding is the seventh wonder of the world. So it keeps
Exactly.
compounding and you will have a good corpus as and when you want. You can always draw, supposing there is a festival, there is a function, there is a marriage. You can just draw a chunk however you want and you know how much is left over there because it's adding some interest. These are two things I thought I should tell you.
That's interesting.
And
Thank
Thank
you
you
so
so
much.
much. Thank you for adding whatever I said. And you are absolutely right. I missed the word withdrawal plan.
yeah,
But this is
because
what
I
I
thought
do.
that would help people. That would help.
Yes.
Thank you. Thank you so much. Anybody else has any question? Other participants?
Where do you live, Saumya?
Right now, I'm based out of Kolkata.
Kolkata. Wow. See, what a great world here. We are all connecting over a Zoom call just like that. Vaishnavi and you?
I stay in Bangalore.
Bangalore. Very good. I'm
How?
traveling. I live in Chennai.
Okay.
I'm traveling to Bangalore next week. If possible, we'll catch up.
Sure,
I'll give
definitely.
a shout out to you. Let's see if
Yes,
time
yes.
permits, we'll catch up.
Both Shanti and I, we live in Bangalore.
Oh, very good. So maybe together, duel.
Yes,
One
yes.
stone, two mangoes. I'll meet both of you there. Guys, come over to Chennai. Plan a trip to Chennai and come over.
I'm going to Madurai next week, though.
Wow, very good. Have a lovely time. Weather in
I'll
Tamil
definitely
Nadu is
come.
good. Hmm?
Lovely.
I'll definitely come. I
Come
can't
on.
say when, but I'll come.
Please do come, and we all have our numbers in the group. So
Right.
reach out to whoever because we don't know where we live and stuff. Reach out to whoever, and we should catch up all the
Yeah,
time.
sure.
I
Lovely.
have one question. This is not related completely to investments in the sense that it's not something that we can do anything about, but this always intrigues me. Why does the government tax capital gains when it wants to promote investments, when it wants to encourage investments?
How does the government run their day to day? They have to see on what do they say only on the gain, because supposing the property, let's take a property. You buy a property when not even you, your father, your grandfather, your forefather, somebody bought a property for a very meager amount, and now the fund has grown effectively. And when you do a sale of it, government says, give us a portion of it because we had helped you, we had laid the roads for you, we had laid the electricity things for you. All of that we've been doing along the way, and that is why your capital, your property has grown so much. Otherwise, the value of the property would not have grown. So for which, of course,
Am I
all
not paying tax? I know this is something that we as individuals do not have much control on. But my question is, we are anyways paying tax otherwise for laying those roads, so many other amenities, right? I somehow feel people who've been doing everything systematically feel the pinch over and over again.
of course,
That's my way of looking at it.
not only you, Vaishnavi, the whole country. That is why many people are surrendering their passports and leaving the country. If you have to look at it, it's a big threat. I will tell you, if you actually calculate the amount of tax that goes out of your pocket by ways of service
Sales
tax, by
tax,
ways of
GST.
GST, you buy grocery, you buy some MRP. Over that there is a tax. What is it? You go to a restaurant, you pay some
Yeah, this-
recreation tax.
Mhm.
What not? You and I are paying more than what we earn to the government as tax. Nobody can voice out.
Mhm.
We have to ensure that we make more money to pay more tax.
Yeah.
No, you have
I'll
to
tell
make
you
more money
one
to
more
pay more
thing.
tax. That's all is the only option.
We
I-
want your help as common people. We want the help of finance professionals to either voice out on our behalf on one side, and secondly, to help us in meeting these additional burden that gets added just because we're doing the right thing.
Exactly.
I'll add one more thing. What
Saumya.
people usually think is that SBI, suppose I'm talking about a bank, as I'm taking example of SBI. So SBI has lot of funds, and why do they charge us so and so money for ATM card, for this, for that? But how a bank runs is like they don't have their own money as such. They are taking deposits from you. Suppose I'm taking 100 rupees from you and I'm giving loan to Shanti 60 rupees. And I'm giving you rate of interest of 5%. I'm taking 10% from her. So whatever is the interest differential, that is my earning, right? But in case of government, they don't have earning as such. This is their earning. They don't have money as such. They are managing their revenue and expenditure. And you must be knowing that government is always in deficit, because in every budget they are floating schemes for kisan, for women, for this and for that, and you cannot say that I'll not pay tax. There are few people who are not paying their taxes, and we get burdened because of that. But the truth is that the government is always in deficit, and they don't have much revenue. So
One,
they are looking for revenues from where they can earn that revenue.
so I'll have to add to this. As Saumya was telling, there is a lot that is lying with the government as unclaimed. There is 2 lakh crore plus of
Right.
unclaimed assets lying with the government. So now all these years, it was lying with the unclaimed division, unclaimed regulator, IEPF. That is where it was lying. Now, effective last September 30th, from October 1st, all these have been moved to the government. So the government will keep using it because it's lying idle. They say we will keep using it. As and when there is a claim, we will transfer it to the IEPF and the IEPF can transfer. So the government always looks for ways and means of avenues where they can utilize something that is lying. And tax is one such way that we cannot avoid. Being an Indian, tax 3 letters that we have to, like a japam, like a Rama Rama, like whatever, we have to say tax, tax, tax.
Tax, tax, tax. Keep take tax. Hear that.
Other participants, if you have any question, please feel free to unmute and ask, or you can use the chat
Either
window.
questions or opinion, anything.
Yeah. The
Yeah,
last one was not a question, it was more of an opinion from my end. So I
Yeah.
somehow feel, when someone does the right thing, they're being penalized, which should not be the case.
True. You're right.
Hello.
Hello.
Yes.
Yeah, I'm Chandan here. I was quite intrigued with all the presentations given by Saumya. And yeah, I really encourage that female, well, coming into that domain of the finance management, it leaves a big impact of the family. I also, are you able to listen to me?
Yeah,
Yeah,
yes.
Yes, Chandan.
We all can listen to you.
Yeah. If you can help us in giving some Excel sheet, predefined formula of how to allocate the fund assets, all this, whatever the capabilities a family is having, it will be great, right? Like if I want to invest in this area, what is the outcome? Some formula-based Excel, a minimum things that will really help to retrospects, introspects of their financial goal.
See, Chandan, in fixed income instruments, I can tell you, but in stock market, mutual fund, there is
No,
no
leave
fixed
leave the
formula.
stock market, because stock market cannot. Every family will have, like, suppose if I'll tell you my case, I will be having whatever money I can take the risk, I will allocate in equity. Whatever is the money I can, mean some part in mutual funds. I'm telling about roughly, like in a year I can invest almost 50,000 in mutual fund, 50,000 in equity, and some of the LIC, some of the medical insurance. What will happen? It will help us to check how much is the tax I'm going to pay, how much tax I'm going to save. It will help us in introspects, a ready-made formula like that.
Chandan, ready-made formula, because not one formula will work. There are a number of mutual funds, there are a number of life insurance, there are a number of health insurance, and it all depends on the scheme that you are taking. So until unless I don't know in which scheme you have invested, suppose a simple mutual fund can have 100 of funds uh, in their fund
Okay,
house,
I'll
and I
just
don't know.
simplify it. I'll just simplify it. Example, if we filing a ITR,
Right.
where I will start filling all the like how much I have invested in this insurance, how much is that. It will give us a like calculation that how much I'm going to be liable for tax.
Okay.
Are you get like that?
See, that a CA can tell you, or I can tell you only if I know where you have invested and where you are planning to invest. Because not
Okay.
all funds will be included in tax saving. If you're investing your money in, suppose, large cap fund, and you haven't you're not going to withdraw it next year or within 5 years, then you don't have to pay any tax. Until unless it is lying
Okay.
with the mutual fund, you don't have to pay any tax on the growth you have. Only when you withdraw in any year, that amount gets
Okay.
taxable, and it is over and above 1 lakh.
Okay. Very nice.
So one
Thank
and a half,
and
please, sorry, up till 1.5 lakhs, we all know that we have tax exemptions. That you can include the investments in your PPF or PF that is deducted from your company. That also can be included into the 1,80,000, 1,50,000. Whatever insurance that you invest in, that goes into the 1,50,000. And whatever medical insurance that you invest, you can claim under Section 80D. For your parents, like if you are going to take a health insurance for your parents, that as well up till 50,000, there is an exemption under Section 80DD.
80DD. Okay. Yes.
80D and the subsection. And then if you invest 50,000 rupees in NPS, National Pension Scheme, up till 50,000 rupees per year, you can take exemption of income tax.
Okay. Okay. What about a home loan? Yeah, there will be two type. One is the how much is the principal amount I'm paying, that comes under maybe ATC, and other things like
Interest.
Interest on
interest.
home loan.
Yeah, that will be direct deduction up to 2 lakhs.
Up till 2 lakhs.
Yeah, up to 2
Yeah.
lakhs.
Now there is something called like the property was handed over late. Okay. So in that, since I was being taken up for the interest by bank, so whether how can I claim that? What is the provision for that?
Every year you have to take one interest certificate from the bank on your home loan. You can go to your branch and you can ask for
No. What I'm asking, already I'm claiming like 2 lakhs for that interest.
right.
But what I hear the case where the property like it was handed over late. Example, the property was booked on 2019
Right.
and it was handed over in 2022.
Okay.
So there is some delay. Okay, so what can be done in that case?
See, bank allows, in case of multi-story buildings, they allow 3 years for the construction purpose, right? In multi-story buildings, I'm telling you. So,
Yeah.
for 3 years, they don't ask you to pay any EMI. But interest accrues on that, so you can take the claim of interest. But after 3 years, even if the property has not been handed over to you, your EMI will start. And once your EMI starts, you are paying principal amount, right?
Yes.
So, if you are paying the EMI, and it doesn't matter whether the property was handed over to you, you have got the possession or not. If your EMI has been started by the bank, then you can take that interest certificate, and whenever you apply, whenever you file your ITR, then that you can see what portion went to your principal and what portion, because that interest certificate includes that this amount went to principal and this much in interest. So you can
See,
put it that way.
yeah, actually, thing is that and the handed over date was already announced, but because of this COVID, they keep on extending, and by somehow they took the certificate from the doctor about, so from the government, that from RERA extensions and all. But thing is that if anything, because already it was the date was announced for handing over, suppose 20 so March 2019, but they
Right.
didn't hand it over, right? And they keep on extending till 2 years.
Right.
So in that case, nothing can be done.
Bank and tax is not related to your getting the possession from the builder.
Okay.
These are
Okay.
two independent things. It is not linked.
Hmm.
Once
Means it is
you
like the possession certificate is required. I just try to
no, no,
take
no, no,
out
no.
that.
You don't need possession certificate. Once your EMI start, you have started paying your principal and interest. And as I told you, that possession and what the builder is doing is not linked to how you will file your ITR and your bank will start your EMI. Bank will not delay taking your EMI after 3 years, even if the builder is delaying the project.
Okay.
So once you have started paying your EMI, take that interest certificate in April and you can file your ITR accordingly. It has nothing to
Okay.
do with your possessiveness, whether you have taken the possession of the property or not. Neither the bank is liable for it,
No,
neither the
no,
government is liable for it.
no. What my one chartered accountant told me, that I can claim for that 2 lakhs of direct deduction in income tax when I get the possession of the house.
No, no.
Okay.
Interest starts from day one. The moment bank will
No,
disburse your loan,
interest
the interest
starts, but
starts.
I cannot claim that till my house is I'm getting possession like that.
Chandan, I'll have to once see to it because if you're saying this, I'll have
Hmm.
to recheck this point.
Yeah,
You
yeah.
can ping
Because
me directly on my WhatsApp and I'll get back to you.
okay, okay. Thank you
If
so
you're
much.
in the group, you can just ping me and I'll get back to you after confirming it that if there is any change, I may not be knowing it right now.
Okay.
Or if there is any such thing, I'll let you know.
No, the Rinjim can contact you directly.
Okay. Rim,
Okay.
no issues. Rimjim,
Okay.
I'll talk to
Thank you.
Rimjim.
Okay. Thank you. Though it was very nice. I hope we'll get the sessions keep on looking into forward.
Yeah, sure.
Yeah. Thank you.
Okay.
Welcome.
Thank you, Chandan, for the question. Vaishnavi, Pooja, Leticia, Rimjim, if you have any other questions, please let us know. Anything from your end?
You please also take some sessions for entrepreneurship. Somebody want to start some small business, how to proceed, what are the things to take care, what is the roadmap, all these things. That will be very nice because it suits so much right now in these occasions and this after post-COVID.
We'll look into it, Chandan. The idea of these sessions is targeted at a particular group. I run a lean in circle called Leader in You, exclusively for women. And these were topics recommended by the women and volunteers. So Saumya is a part of the lean in circle and she's volunteered to do this session for us. So these are not for not for the open audience. We invite only the lean in circle women to attend these sessions. And if there is interest, we'll definitely check on this. And if there is interest on entrepreneurship, why not? Of course, we need to find a resident expert in the community to be able to deliver that too. I'm sure we'll find there are some phenomenal women in the group. We'll do.
Thank you. That's really nice to hear that. Thank you so much.
Thank you.
Pooja, you have something to say?
Yes. So first of all, thank you so much for this amazing session. I don't have any questions per se. I just thought that it would be really good if we could have one more session where we can deep dive into some of the investments, and even like small things like how to use credit cards or how to consciously spend, overall. So maybe we can have one more session for such smaller things which we miss out in our daily lives but can really help us consciously save our money.
Thank you for the suggestion, Pooja. Yes,
Yeah.
Shanti.
Yeah, we
I
can do
have
something like an open house where
a
people can come and
question.
ask their specific questions.
It would
And
be nice if we can, I mean, summarize that what you exactly you want to know, so that it will be beneficial for me to address all
curate
those
that
queries.
session. Yeah.
Yeah.
So that's why I was thinking maybe we can have an open house where people come with their finance related questions and you answer them one by one. I don't know if that works.
Yeah, if they can mail me or something their queries, I can I mean that presentation will be accordingly that their question, all the queries get addressed, because I have also to prepare myself for
Prepare
that.
totally.
Right.
Letitia, you wanted to say something?
Yeah. So, I don't know if this is a question per se, but the thing is, so for me, one of the questions that keeps coming up is, so via my company, I am investing using the employee stock purchase program. But when it comes to selling it off and managing that efficiently, it's something that I struggle with, and I don't know what to do about it. So I think this is a very niche question, and I don't know if we should dedicate an entire session to it. But I was wondering, is there anyone of the group I could ping and ask about this?
Saumya, and probably now Bhanu, we didn't know what her specialty was. So Saumya, Bhanu, Neha is also part of the group for Letitia. They're all finance experts. Throughout the question, I'm sure people will share their experience in the group.
You were talking,
Yeah.
Leticia, you were talking about ESOP, right?
Yes. Yes.
Okay, I'll have to see to it, because it will also depend on what conditions the company has given it to you, because there are some lock-in period that you cannot withdraw that amount, or you cannot sell that amount within 3 years or 5 years, because sometimes that company is not registered and they give you ESOP.
Yeah.
And
No. So it's not an
until unless they
ESOP.
get listed, because they have to get
Uh,
listed in the stock market, then only you can sell
Correct.
s-
Correct.
your
So this is a NASDAQ
stocks.
company actually. So they're an established MNC. So they are on the NASDAQ, and just so the moment, so ESPP is such that every month some money is taken out of my paycheck, and every 6 months that money is consolidated and the stocks are purchased. Right. And as soon as they are purchased, they become eligible for me to sell. So there is no lock-in period or anything like that.
Okay.
So, yeah, so I have been in using this program to purchase the shares, but when it comes to selling it and then investing it back in India, I'm getting I feel very lost and scared of tax implications and all of that. And I just do nothing. So I just need to know, to take that first step, like, what do I do now?
If you're earning anything from India, then you have to pay Indian taxes. But if you are outside India, then you have to pay taxes according to your company, because you must be knowing that there is a FATCA, which is FATCA, which you have to comply with, especially for if you
No,
are
uh,
residing in US.
no,
So
no, no. I'm residing
that
in India,
ways,
so that is not a confusion there.
yeah.
Residing
So
in India, but have US based stock, which they are using the WH bin. So
this is a US
whenever
based stock,
that
so
purchase happens,
you will pay in tax according to the US government. So there is anyone can help you. That after
no, no, that I don't
after
have to pay
selling,
US tax is what I'm trying to say. Because there is a form called WH bin that makes sure that because India and US apparently has some sort of tax treaty, since I'm an employee, I don't have to pay US taxes. I just have to submit that form every 3 years, and I don't have to pay US taxes. Only India
okay.
taxes I have to pay.
Okay, I won't be able to tell you about this, because this is related to reconciliations of money, and foreign currency is involved. Uh,
Uh-huh.
but I think there are other professionals who would be able to address this issue.
Sure. Anyone on the call right now? By
Banu,
any
you're on
chance?
mute. I think you're trying to say something. You are on mute.
There is a treaty that is signed between many governments, which is called the Double Taxation Avoidance Act Treaty. So once you have signed that, and as per the rule, you pay tax in one of the countries, either here or the country that you reside, the shares you have wherever. But you don't pay tax in both the places. You only pay
Correct,
the tax in
correct,
one place. So it is
correct.
like that. So you can choose accordingly where you file your returns and pay tax in that respective country.
No, so that is set. That I have no confusion on. I know I have to pay taxes in India, but for me, it's like it's about diversifying, right? Like I have all these shares sitting here. Now I want to sell them and reinvest in India.
Okay.
And I mean, I'm based in India still, but reinvest in other portfolios or asset classes,
Oh,
right?
yes. Yeah. We
Yeah.
can do that.
So
Yes, you can do it, Letitia. That is not an issue at all. But if you want some support in selling the shares, you can connect with me and we will see. But if you're selling shares is now not a big deal at all. Onto the platform, you just buy, sell is made that easy. And if you want to look at proper investments on how to make this money work for you, we can connect as well, and then let's see how best
yeah,
you'll be able to
I think
work on.
I'm kind of stuck in the step between these. For example, like how do I sell this? Like, is there things like that I should be looking at, like sell only X amount of shares per year so that I don't get taxed for something that I'm not aware of and things like that, right?
Letitia, your voice is breaking, I believe. That's why
Yeah.
I'm finding it a little
Yeah,
difficult to
sorry.
follow.
I'm traveling. I just
Yeah,
contact you separately. Sorry.
Yeah, please.
yeah, we are not able to hear you clearly. That's our only constraint, which is why I
I'm
think.
just putting my ears like this, but still the voice is crackling. That's okay. We'll talk later.
Thank you for that question, and thank you, Saumya and Banu, for responding to each of our queries. I think all of us have shared their thoughts, opinions, and clarified their doubts. I think we are good to wrap up today's session. Heartfelt thanks to Saumya for taking your time out and spending, I don't know how many days she must have put in for this presentation, number one. And also she had been so genuinely trying to follow through all our guidelines for sharing those promotional content, be it the write-ups or the video content. So she was constantly looking for a validation, saying, is this enough? Am I okay in this particular video? That showed how sincere and serious she was in trying to help us gain insights from this presentation. Thank you for your effort, and we truly appreciate this.
Thank you so much.
Saumya and Banu, thank you for that insights, and we really appreciate you coming in and helping us out with your valuable thoughts and your inputs as well that helped us expand our understanding of some of the concepts. So thank you to you as well. On behalf of Grow with Satori team, my heartfelt thanks to each and every participant who took time out today to be here, spend your 90 minutes with us so that you gain something in return. I'm sure we will have more questions, I know, as we go forward, but this is just the beginning. This has helped us gain that motivation to make a start no matter where we are, or continue with the journey no matter where we stand in our own finance journeys. Thank you so much, everyone. Have a wonderful weekend. Looking forward to connecting with you all once again in another session from Grow with Satori's Leader in You, Lead in Circle. Thank you all once again.
Thank you all. Thank you all.
Thank you all.
Thank
Thank you,
you.
Vaishnavi, for all your
Thank
support.
you.
Thank you, Grow with Satori, for this opportunity.
Welcome.
And thank you, Shanti, for your support. And thank
Our
you to all
pleasure.
the
Our pleasure.
participants that they took their time for this session. It was pleasure, and I'm so encouraged to do more such sessions now. So
Lovely.
it was
Looking
really
forward.
wonderful. Thank you so much, everyone. And thank you, Banu, for adding and giving your insights.
Bhanu has left, but I'm sure she feels your thankfulness. Thank you.
Thank you all. Bye-bye.
Thank you. Bye-bye.